Joining us on the show now is Peter Cardillo, Chief Market Economist at Spartan Capital, and independent emerging market commentator Geoffrey Dennis, who joins us from California. Gentlemen, both of you, good morning and good evening respectively. Thank you so much for joining in. Jeff, let me start off with you. What did you make of the tweet? I think it was going right down to the wire. This maybe gives some breathing space, and should the markets take this positively?
Oh, yes, I think the market should take this positively. I think, as your reporter said, it wasn't particularly a gigantic surprise that we have seen this deadline pushed out before the tariff increase comes in. But still, there's always a degree of uncertainty, and, of course, there's many issues still to be resolved. But I think this is uniformly good news for the markets at the moment, and you're seeing that reflected in a big jump in Chinese shares, of course, this morning, and also a nice move higher in the futures in the U.S. So I think you view this as reducing the risk at the margin of an escalation of the trade war, which would be damaging for the global economy. I think it's good for risk assets. And so although the issues have not all been resolved, this should be viewed as extremely good news, I think, for risk assets.
I must say it is playing as per script on the basis of what Geoffrey Dennis has been telling us in the past. He kind of half anticipated this were to happen. Peter, how would you view this? It is still subject to some meetings between Trump and Xi Jinping, but after 2 weeks of extended conversations, which got extended to the weekend, by the way, this should be taken positively. The equity screen this morning, for example, is showing that the markets like what's just come out.
Yes, I think there's no question about it that the fact that, President Trump extended the deadline obviously means that we're very close to a deal. And of course, I think that's what's creating a lot of enthusiasm in the market. And I think that, the fact that the market continues to rally is a good sign that not all of it is actually already placed in the market. By that, I mean that when and if we get a deal, and I believe we will get a deal, the market is probably not going to pull back. So I don't think investors are going to sell on the news. Now, that doesn't mean that you can't have a small pullback before a deal is announced, but I do believe that a deal is in the makings, and that deal is going to avoid a very chaotic global economy. And so the market, I think, will look forward and say, well, now a deal is reached, so we can see perhaps stabilization in the global economy and perhaps even a rebound.
Interesting. Peter, a lot of commentators in the run-up to this decision, it's not a decision as yet, but whatever decision has come out, were saying that what a truce would do essentially is let the markets continue the way they normally would have. A breakdown in the deal would have brought a pullback. This is now returned to normalcy. My question to you is, what is normalcy for the U.S. markets? S&P is trading at levels from where it's retreated each of the 4 instances since October that it has managed to reach there. Do you expect normalcy to be a higher S&P 500 and higher Dow, or could there be a bit of a pause here?
No, I think, as I said, I think the market is going to continue to rally. However, there is one major problem that lies ahead, and that is first quarter earnings. It does appear that we're probably headed for a real slowdown in earnings. And I would probably think we could be headed for a recession, an earnings recession. So that means that valuations would probably be pressured. But again, we're over 7 or 8 weeks before we begin to see those earnings. So I think from now to earnings season, the market probably will continue to rally, and it will rally, as I said, because of a trade deal.
Okay. Jeff, how important is this for the emerging market pack as well? China notwithstanding, and the fact that the yuan is a lot more stable in the run-up to the deal and post this a tweet by Donald Trump as well. How important it is for an emerging market watcher and from an India perspective too?
Oh, I think it's very important indeed for emerging markets. I mean, clearly you haven't seen much in the way of additional generalized dollar weakness, at least in the first few hours after these tweets came out from the president. But the strength in the CNY is very helpful. But in general, I think, whereas, as Peter says, the U.S. market will have to deal with pressure on earnings and potentially, clearly, high valuations. EM is much cheaper. It's not super cheap, but it's much cheaper than the U.S. We typically do well when the global economy is doing well. At the margin, as I think we all agree, this is helpful for the global economy, assuming eventually we do get a full-fledged deal. And if that coincides also, which is my view, with further dollar weakness, you take, even more than has been the case recently, you take worries about the Chinese currency off the table, which obviously in the last 3 or 4 years periodically has been a concern. So I think, as I said in my initial comment, this is very good for risk assets. And I think this sort of news, if it ultimately translates into a trade deal, a full-fledged trade deal between China and the U.S., does put a floor into the global economy, and I think will allow emerging markets to outperform in 2019.
Well, let's see. And let's see if India participates in that also or no. But gentlemen, both of you, thank you so much for staying up this late this Sunday evening and giving us your thoughts. Really appreciate your time.